Welcome everybody. Thank you so much for coming out. I really appreciate it. I'm excited about this topic. I'm glad we had so many people register and show up with the weather. So thank you for coming to support CVAR's training events. And thank you ladies for helping get this set up, Jamie, and thank you for the warm welcome. Topic for today is investing in investors. So a lot of the work that I've done over the last couple years, especially during the pandemic, was people wanting to get into the world of investing, asking a lot of questions, moving from homeowners to investors to even people that are renting that want to invest investment properties, short-term rentals, long-term rentals. And a lot of the questions that come up are always the same. You know how it is in real estate, it's the same questions all the time. So I'm just trying to spread the knowledge of the things that I'm answering every day for people that are trying to make this transition from homeowner to investor, or first-time investors, or even experienced investors. So I wanted to go through some of the things that I've learned over the last couple years. They're always changing, as you know. With lending, our guidelines are changing as the markets are going crazy. Lenders are always changing their guidelines. So first I wanted to talk about my why. I know you can't see it too well on here. This is my family, and the reason that I do all this, the reason I got out of the corporate world, went into something more independent, like being a mortgage banker, mortgage broker, is to have the time to do the things with my family that I was missing out on in that corporate life back 8-10 years ago. So this is my family, my wife and 6 kids, and we love taking epic vacations. So this is a couple of pictures. We were in Mexico last year, in Ireland, and my oldest son joined the Marine Corps a year ago. So this was at his boot camp graduation, and we're really proud of him. He has a great job in the Marines. He is a musician. So he's a full-time musician. Part of his deployment last month was to go to New Orleans to march in the Mardi Gras parade for a week. So that's the kind of great stuff he gets to do as a Marine. He did also just do a 28-mile hike in New Mexico in memorial of the Bhutan Death March that was last week. So he's doing his Marine stuff and musician stuff, and keeping the family very proud. So that's the reason why I do what I do. Just some quick market updates. So in California, I just pulled this off of the CAR website. Last month, there were 284,000 units sold in California. And we've seen some ups and downs, obviously, this year. So we're down 33% year over year with the units sold in California, but we're up 17% from where we were last month. So things are starting to pick up. In my opinion, we've kind of come through the worst of it with rates and inventories increasing. But it does show that we're on an uptrend again, and 15%, or about 1/6 or so, of these transactions are for investment properties. So out of the 284,000 in California, there were 42,600 homes purchased as investment properties. Now those are just the ones being designated as investment properties. Part of what I'm going to get into is this house hacking trend that's out there for people buying a primary residence, turning that into an investment, buying another primary residence. So I don't even think this captures all of the data for the amount of transactions that are happening that are investment properties. So it's a really big part of the market. It's something that adding it to your business and focusing on this, having the right information for your clients, whether they're thinking of just getting started in investing or have some more advanced questions, it's a really big part of the market that we can all tap into if we can serve it well. And the other trend that's happening is that during the pandemic, there was this huge trend, and even before, of institutional investors buying all the investment properties. Half of the transactions were by big companies that were buying all of the inventory in a lot of these towns. Sacramento's kind of famous for that. They had BlackRock come in and just buy thousands of single-family residences. And now that trend is going down a little bit, which leaves more opportunities for the individual investors to not have to be so competitive in that investment pool. So the demand remains very high, and inventory is relatively low. So as we know in California, as the population continues to increase, and we're still seeing very little inventory, that's putting all the pressure on this supply-demand imbalance. And what we're starting to see is that even though prices have been declining, which makes sense over these run-ups the last couple of years, we're starting to see prices come up again, and multiple offers and busy open houses. So I think we're starting to see that, especially as we go into the summer. So the opportunity for individual investors in our area. So I combined the Central Valley and Bay Area, because that's kind of where the majority of people are working in this area. And there's about 8,000 listings. So that means that about 1,200 of those will be investment property purchases over the next month or two. That's the inventory that we have, and that's how the numbers kind of shake out. So this again is investors purchasing at about 18%, which I already covered. This just shows up through the fourth quarter, and it's a trend from 2002 that shows the trend of investors and how they've been buying. Obviously a big drop off at the end of last year, but we're already seeing that, we're ahead of where we were last year with investment property purchases. And then this is showing the single family attached versus the detached rental units that are being bought. So just again, the trend and what this craziness that happened during the pandemic. Obviously here this decline was during the 2008 crash that we had. And then the other thing that everybody's talking about that I wanted to cover really quickly was the affordability index, right? As the interest rates have continued to go up, people's payments are going up, things are getting tighter on who can qualify. But the reality of it is that as the mortgage payments go up, the interest rates go up, then we're seeing the price growth decline. So this middle line here is the 0% line. That means no growth in prices. And you see as we had these super low interest rates for a couple of years, the prices of homes kept going up. And then now that interest rates are getting really high, the acceleration of price growth is going down. So we're getting to very little increase in price month over month and year over year, and actually a decline in these last couple of months. This is a chart which I'll be happy to share with everybody, but this is the nuts and bolts of what's different about investment properties versus primary residences. I know it's small and hard to read, but this is what's called a loan level price adjustment chart, and it's from Fannie Mae, and it dictates how many points get added when we're working up a loan product based on the scenario. And the numbers that I highlighted here, which are pretty crazy, you can probably see this 4.125. That's the maximum. So that means that if an investor, this line here is for investment property, that means that if an investor is buying a house and somebody is buying it as their primary residence, the difference between those two is going to be 4 points that are charged to that investor for that same loan. So, if they're only putting 20% down on the loan, somebody may be getting a 6.5% rate right now, but that investor, to get that same loan with 20% down on that home, they have to pay 4 points to get that 6.5. So that's the main thing that I want you to take away from how these investment property loans work in the conventional world. Conventional, I mean Fannie and Freddie loans, that these loan level price adjustments are huge for investors. And what they did last year is they merged basically what investment and second homes were being charged, because a lot of people were buying second homes, they're being classified as investment properties later, and Fannie and Freddie said, no, we're not going to have that anymore. So we're making these same adjustments for second homes and investment properties now. So again, if you're only putting 20% down on an investment property, you're paying 4 points in fees to have that loan versus what somebody would be if they're buying it for a primary residence. Does everybody get that point?
Yeah. So it looks like there's a sweet spot up there too.
Yep, exactly.
So like just putting 5% more down, you're saving 2 points.
Exactly. Yep. So if you put 25% down, then it goes down from 4.125 to 2.125. So this is the big thing that differentiates investment property purchases versus your primary residence. Because on a primary residence, you can go all the way up to 90 or 95, and you're only having a quarter point added on for your for the points that you're paying. An investor, putting 20% down, 4 points, 25% down, they're down to 2 points, and of course they're putting 40% down, then it goes down to the baseline of the adjustment of 1.125. So thanks for sitting in the front row and seeing the numbers. Any other questions on how this works? Because this is an important point. I get calls from investors all the time, and they say, why are these rates so high? What are the differences? Why are you gouging me just because I'm an investor? And it's not the lenders. It's the banks and the wholesale lenders. It's not the mortgage brokers, the loan officers. These are the points that are getting charged by Fannie and Freddie and are dictated as part of this investment loan program. When we submit the loan to them for sale, this is what we have to pay. So that's why this is charged to the consumer. So there's no punishment that's happening there. This is the way that Fannie and Freddie have set it up. You have a question?
Can you repeat how it's broken down for primary and secondary?
Yeah, so this first line up here, basically this area is talking about a primary residence. So you can get a primary residence for 3% or 5% down, and in that case, there are no adjustments that are on that basic loan unless it's an adjustable rate mortgage or it's a condo. Something like that will add to the points that you have to pay. But the starting point is 0 if it's your primary residence. And then as you go through this chart, it tells you how much you have to add on for the points for these different scenarios. And the one that I'm pointing out is for an investor. If you're buying it as a primary residence with 20% down, you'd have 0 points here. If you're buying it as an investor with 20% down, you've got 4 points added on that you have to pay. So you either pay those points or you have to take a higher rate. And with rates that have gone up so much, there's not even the option to say to an investor, okay, you can take this rate at 8 or 8.5% with no points, because that doesn't exist. The way that the financial markets are going is rates are going to come down eventually. So lenders don't want to put out all these loans at much higher rates that are just going to get refinanced. So they're not even offering the loans at these super high rates to avoid the points. You could probably get out of half of this if you take a rate that's 1% or more higher than the market. So if a primary residence purchaser can buy a home at 6.5% with no points, the investor has two choices. They can buy that same scenario at 6.5% with 4 points, or maybe they can go up to 7.5% and pay 2 points. Right? That's the other misconception, and that's this kind of basics in the mortgage lending world, is that the points don't correlate in a linear way to the rate. When you're paying 1 point, it doesn't mean you're getting 1 point lower, right?
And that's why it feels like punishment.
Exactly. So this is a question that I get all the time when I have to talk about rates, what they are. Maybe you need to put 25% down. We can get your points down a little lower. But again, this isn't coming from your loan officer or the bank or the company. This is coming from the government, Fannie and Freddie, who buys these loans and backs these loans. This is what they're charging. So this is why the banks and lenders are charging this much in points. Any other questions about this? It's an important piece to be able to explain when they come to you as a realtor and say, why did you refer me this lender? His rates are super high. He's trying to charge me 4 points for this investment property. Now you'll know why. That's what's going on in the background that we have to deal with. All right, so to go through a couple different types of investment properties, obviously single family, multi-family, multi-unit up to 4 units, and then more than 4 units. If it's more than 4 units, it's typically going to fall into a commercial loan or some kind of specialty lending. So most of the numbers that we're doing for investment property purchases, and especially in this area, and working with your local lenders, we're mostly focused on these 1 to 4 units, because that's what all these conventional loan programs apply to. There's 1,000 different loan programs for people to qualify for, depending on what scenario. Your loan officer that you're working with can always help you find a solution, but when it gets over 4 units, we're usually referring that out to a commercial lender or some kind of a specialty. So for residential unit investing, one of the things I mentioned was house hacking, and one of my favorite things to talk about is the VA and FHA house hacking approach, where you can buy a home as a primary residence, even if it's up to 4 units with very little money down. Has anybody heard of this approach before? Okay, so
as long as they leave it 1 unit.
That's right. Yeah, exactly. So for the government programs for VA and FHA, your buyer can buy up to a 4-unit property and classify it as their primary residence if they're occupying one of those units. That's exactly right. And that's kind of the key to helping people that are using FHA and VA loans to get into this investment property, to become investors early on with very little money out of their pocket. Because with the VA loan, you can do no money down, right? And with an FHA loan, you can do 3.5% down. So on these multi-units, you may have to put a little bit more down. Like on the FHA loan, sometimes you're required to put 10% down, or depending on the structure of the loan. But it's really a good way to help buyers that are using VA and FHA loans to get into a property, multi-unit property with very little money down. And the great thing about it also is that there's rules for counting that rental income off of those other units. So they can qualify. Like I was helping a guy in Sacramento buy a property, a 4-unit property. He was coming in with no money down on a VA loan, and he was using the rents from the other 3 units that already had tenants in them to help him qualify for the loan. He only had his military retirement, and he was able to qualify because the income from the other 3 units was enough to cover those. So that's a way that you can help advise your clients if you're looking at, if they're trying to come in and make a conventional purchase and they know they need 25% down, then that's a non-starter for people that are just getting started out. So with a VA and an FHA loan, they can come in with very little money down and also use those rents to qualify. There's a couple of things to keep in mind when we're talking about using the rents to qualify. There does have to be an appraisal done on the property. The appraiser is going to do a market rental analysis, and then if there's existing leases, we're going to look at all that information when we submit it to the underwriter, and we have to use the lower of either the market rate or the existing leases. We're going to look at all that information when we submit it to the underwriter, and we have to use the lower of either the market rate or the existing leases. Now, go ahead.
So how many years back are you looking at the rent?
So how many years back?
Is it 1 or 2 years?
So when there's a couple of things there. So when the appraiser's doing the analysis, they're just doing market rent like comps. So they're taking what the current market rent is. If you're trying to use rents to qualify, then if it's your home that you're living in, we go back 2 years to prove rental income. But if you're buying a new one and trying to use the rental income from that, we will look at the rent history, but it's going to either be based off the current lease or it's going to be based off the market rent, whichever one is lower. Does that answer your question? Okay. Because the other thing I think that you were bringing up is that if you already own investment properties and you're trying to use that for qualification, then the lender's usually going to want to see 2 years of tax returns to see how you're claiming that, what deductions, depreciation, how we can use that for income. So that's the other thing that comes up if you own an existing rental property. In this case, what I'm talking about is buying a new rental property, taking over the tenants, or getting it rented. Yep.
I just wanted to add too, on the lending side of things, and I found that there's a big misconception out there too, that after the 12-month occupancy, you can turn a VA property into an investment property.
Exactly.
You can refinance it as a VA loan as an investment property, but it's different for FHA, right?
Yep. Yeah. Exactly. So that's a great point. The VA loans have tons of flexibility. And as a veteran, as having veterans in my family, I work a lot with veterans, and there's all kinds of flexibility on there. The great thing about VA loans is you can call the local VA regional office, and you can get an underwriter on the phone basically, and they'll tell you how to interpret the VA guidelines when there's something that may not be cleared. So exactly. So the next step in this house hacking, and that's exactly what you're talking about, is you can get into a house, you can buy it as your primary residence, and then when you're signing all the documents at the closing, your buyer's signing that they intend to occupy it as their primary residence. So that means that they're supposed to stay there for 1 year. So after that 1 year, they can keep that loan on the property and go and do the same exact thing the next time, depending on how much VA eligibility they have. If they're getting assigned somewhere else, if they're active duty, there's all these little rules about how they can reestablish their VA eligibility. Sometimes they can keep it on the same home if they're being deployed or moved somewhere else, or maybe they didn't use all of their benefit and we can apply the remaining portion to their next purchase. So there's a lot of flexibility with the VA loan. And the FHA loan, there is a rule for FHA that you're not allowed to have 2 FHA primary loans at the same time, but there's exceptions to that also. There's, if there's a family situation, if it's more than 60 miles, sometimes you can get a second FHA loan for another primary residence. So VA and FHA have a lot of flexibility when it comes to this, and they're the best way to help people that are wanting to get started with investing. The way I usually start the conversation is, how flexible are you? Do you have kids in school? Are you tied into this community? Can you move in a year? If you have this plan to try to build up some investment properties, it may require some flexibility because you may have to move each year for the first couple of years to establish your first couple, but it's really a great way to help people build wealth through investing. Okay, so for conventional loans, they need at least 15% down, but as you saw on that LLPA chart, it is punishing the less down payment you put. So it's possible to buy a investment property with a conventional loan with only 15% down, but you've got PMI and you've got a lot of points that you'd have to pay. So I recommend trying to get in the 25% range if we're not using the VA or FHA low down payment. Come on. And then on multi-unit, it's usually a 25% down payment minimum that's needed on those. And then the ADU options I put on there also because that's become super popular. People adding ADUs. There was some legislation that changed in the state of California in the last couple of years to encourage people to have up to 4 units on their property. And so there's a lot of activity with ADUs right now. There's even a grant program through CalHAFA that gives money to help people build ADUs on their property. So there's a lot going on to try to increase the number of housing units in California, and investing in a property where you can add an ADU, or if it already has one and you can count that income, there's some different rules around that also. The other thing that I wanted to talk about regarding this is so I have a story to tell about one of my favorite clients that I had last year. He was a professional poker player. He is a professional poker player. He lives in down by San Diego. and he's renting a house near the beach in San Diego. He worked out with his landlord that he could Airbnb the other 3 bedrooms in this house that he's renting. So he's, doesn't own the house, he's a tenant. He's basically subletting it to these Airbnb tenants that are coming in and out, and he was making an income off of this because of his location near the beach. So he was referred to me by an agent down in 3 Rivers, near Visalia, by the entrance to Sequoia National Park. This guy wanted to buy an Airbnb that was near Sequoia National Park. He saw some great opportunity there, and she called me. She said, how can we classify this guy's income? He doesn't make any money on paper, basically. He's a professional poker player. So how are we going to work this? So what we were able to do is put it into one of these non-QM programs called a DSCR program. A DSCR program is called a debt service coverage ratio program. And what that does is it bases the qualifications only on the income of the rental property. So let me back up just a little bit with this poker player guy. So we were able to buy his first Airbnb with a bank statement program. So that's falling into this other non-QM, self-employed bank statement programs. So we were able to classify him as a professional poker player. He'd been doing it for 5 years. He could document that he was in these tournaments and had this income for 5 years. But it wasn't enough claimed on his taxes to be able to qualify him. So we were able to use a bank statement cash flow program that we could show he was making consistent deposits every month for the last 24 months, come up with an income calculation. And he actually bought this Airbnb in 3 Rivers, $1 million, had like 5 units on it, basically, bedrooms that he could rent out. And so we were able to do this first one with a bank statement program, even being a professional poker player, qualifying his income that way. But then he wanted to buy another one, and the income wasn't going to be enough from his bank statements, so we did what's called a DSCR program, which is this debt service coverage ratio program. Now, this program kind of reminds me of the old days where it was the NINA programs, no income, no asset kind of programs, right? So that those there's some baggage that comes with these no-doc programs that people think about when the economy crashed and we had the crash in 2008, right? All these risky loans that were out there. So the difference now is that for these DSCR programs, they typically have to put 25% down, right? When they were doing them in the old days, it was no money down or whatever, and your payment was tripling in 2 months and everybody lost their houses, right? So for these DSCR programs, we were able to get him qualified with this. And the cool thing about this, and I'm just illustrating this for the creativity that's out there, to be able to help people that are motivated to be investors. There's programs out there to help people no matter what their situation is. But with the DSCR program, we were able to use short-term rentals. So we were able to show Airbnb rental income from that area. And that's a new thing in the last couple of years that lenders are finally allowing us to do, is to do a survey of the short-term rentals of the Airbnb income instead of having to qualify off that appraiser's analysis of the long-term rental, right? It's very different what you're going to make renting out a house in Visalia or 3 Rivers on an annual lease versus what you can get for Airbnb income. So there's a great website called airdna.co. It's airdna.co, and they have all the data from Airbnb and VRBO. If you put in any address on there, it'll tell you exactly how much money your area is going to make based on the type of property it is, the number of units, and what happens. All the Airbnb and VRBO data feed into this because they're very meticulous on their accounting, right, for taxes and everything else, and all the reports that they have to send out. So they've allowed access to this airdna.co site where you can see the real numbers of what somebody earned in the last couple months off their Airbnb. And it's a great way to now let the lenders see what the potential is for the investment properties using short-term rental income. So that's a recent change that's actually pretty exciting that the banks changed in a relatively short timeline. Usually it takes so many years for all these changes to happen. This got implemented over the last couple of years, but I guess Airbnb's been around for a long time anyway. So, hard money. What do you guys think about when I say hard money financing? Anybody have an opinion on what that is or what that means for investors? Short term, right? And expensive, right? So like I said, there's always, I kind of put these in the order. Hard money and seller financing maybe can be interchanged, but the order of cheapest to most expensive. So we've got conventional, FHA, VA. You can use qualified rental income, non-QM, maybe bank statements to qualify, or these debt service coverage where there's no income required. They're just using the asset and the down payment to qualify with the rental income. And then hard money typically requires a lot more down payment, usually like 40% of cases that I see, and they're charging a lot of points up front. It's usually for a shorter term, a year, 3 years maybe, and then it's a balloon. You have to have a plan to exit out of it. And then there's seller financing also, which you're probably all familiar with, where you can get the seller to do some kind of a carryback for all or part of it. Do you have a comment, Dave?
Nope,
Just salute. All right.
That's awesome.
I have a question
Yeah.
about the DSCR. I'm fairly familiar with it, but not sure about in California.
Mhm.
Are there options for house hacking with that, or is that strictly investment only?
So it has to be an investment property.
Yeah.
It has to be an investment property.
Right.
And the holdup for people that are usually doing their first investments is the down payment, especially in California, that you need 25% down to use the DSCR program typically.
And you can't occupy.
Yeah. So she was asking with this house hacking, trying to build up rental properties by occupying them first, basically.
Yeah.
Can they use the DSCR program to do that? And the answer is no. The DSCR program is only for investors. So you have to show that you have a primary residence somewhere else. Like this guy that I was working with, he had a primary residence, which is a rental that he was renting in San Diego, but he was buying these properties near Sequoia National Park.
And obviously, is there an issue with city requirements that forbid Airbnbs?
Absolutely, yeah.
Like a map, don't go here.
Yeah, and that's changing very quickly too. I do a lot of business down in like 29 Palm Springs area, and they have, in San Bernardino County, they've changed very recently, and even down at the city level. So it's counties and cities and neighborhoods. People are getting very strict on the Airbnb allowances and the fines and everything else, that the underwriters will do their due diligence when they're looking at the property, and they'll look to see what the regulations are in that county before they're going to approve a loan with short-term income as qualifying. It's the truth is always going to come out in lending these days. That it wasn't so much in the past, but there's so much data that's out there that the banks, the underwriters, and hopefully your loan officers are going to do a lot of that research up front to make sure that they're not getting 20 days into a transaction and then finding out, oh, there's no more Airbnb permits. And Palm Springs is a good example. They don't grandfather in the Airbnb permits anymore. They used to, but now if a new investor comes in and buys it, they have to apply. And Palm Springs has very specific neighborhoods. I'm just mentioning because I was just down there for my daughter's in cheer, and we were down there for a cheer competition, so I went to some open houses and was talking to some realtors there, and they're very specific by neighborhood. Like only 20% of each neighborhood can have Airbnbs, and that's very restrictive, and they don't turn over to a new owner. So it's affecting the investors that were investing there over the last few years. Now they're stuck, they can't sell, they've got all this equity, the appreciation has been crazy, but now if somebody new comes in, they either have to live there as their primary residence, or they have to reapply, which there could be somebody ahead of them in line, and it could take months or years for them to get a new Airbnb permit. So yeah, good questions. Anything else on these different types of financing or programs that are available? Yes?
I'm just curious, I'm noticing a lot of like LLCs, companies buying up properties, especially, I was just on the Sonoma Coast this last weekend, and there's been, like, the locals are saying that these companies, who they don't even know who they are coming in and buying up, I think last year it was like 140 properties.
Yeah.
And it's vacant land, it's residential properties, it's multifamily, there, many different companies are just coming in and buying these things up. Is that because it's better for your loan, or do you think that that's just a...
So a lot of those are institutional investors, like the example I gave before in Sacramento of BlackRock just buying up every single family residence. Oh, this happened over a number of years. So there's a lot of institutional buying happening, and when I'm talking to clients about the market, what's going on with investment properties, I always say look to the builders, because they've got these long timelines and lots of research and economists that are deciding where to put their new subdivisions. And then also look at these institutional investors like BlackRock and these companies that just buy up lots of units. So they're buying that because they see the equity play that's there over the long term, right? So it's just like any other type of investment that's coming from any company to try to make their investors money. Is real estate is a solid place to put it, right? As we all know from what's happened in real estate over the last 2,000 years, the price has gone up, right? So I think it's mostly institutional investors in a lot of the cities, but in places like the Sonoma Coast, I'm guessing it's probably more individual investors or
and several.
Yeah, so it's like syndications and that kind of stuff where they're putting together a group of investors and buying up these lots. Now, for buying a home in an LLC, each lender has different rules about that. So typically when I'm working with the individual investors, they'll ask about putting the house into the LLC, can we close in the LLC, all these different things, and there's different liability and taxes and all that kind of stuff. So the way that we usually do it is we have them purchase the home. You can't get a loan for an LLC through regular lending. That's a commercial loan, right? So it's yeah, because they're going to give you it's commercial financing, so they're going to analyze your business operations and all that. To qualify for conventional loans based on your credit, your income, the property, and that kind of stuff. So there's a difference there. And most of these LLCs that are buying, they'll be in somebody's name, and then they'll deed the property to the LLC after the closing for the liability and the taxes. Yeah. Does that answer your question?
That helps, yeah.
Okay. Anything else on this topic? Different types of loans? Okay, I put together a whole bunch of numbers. I've got a spreadsheet I can send you that you can plug numbers in for the home purchase price, the property management fees, the taxes, all that stuff to help you calculate the return on investment. But this one, just to go through, I know you can't see it very well, but for a $500,000 investment property in our area at the current 7% rate, you're charging $2,500 per month over 5 years, you're going to make about 120% on that initial investment. So that's just some rough numbers of how to help investors understand where the return is on their initial investment of 25% down. If you're putting 125,000 down, then after all your expenses and taxes and everything, you're probably going to make about 150,000, counting the appreciation, counting the loan pay down over that first 5 years. So again, just a really quick overview of where the opportunity is. In California, it's really tough. During the pandemic, I got licensed in 6 other states because a lot of my clients were moving to Florida, Texas, Arizona, Nevada, all these different places. And what I was helping them do is get their pre-approvals together and their loan scenarios before they moved to these other states, because that's where a lot of the opportunities were with the lower cost housing. So in California, with the higher costs and the taxes and the different attitudes towards landlords and everything that's going on here in California, there's a lot of people investing out of state. So the numbers can be much higher in different areas, especially like Florida and Texas, where they're buying homes for $200,000 or $300,000, and the rents are similar to what they are here. The rental growth over the last few years has been crazy. Also, I know in Miami, the rents have gone up over 50% in the last 2 years. So there's a big opportunity for people buying investment properties in other areas at a lower price point. But an important tool to be able to give to your investors is some basics on the return on investment in a realistic way, because you've got to count property management, the taxes, the interest on the loan, all those kinds of things. And then there's the tax advantages that are there also for owning an investment property. That's a discussion I have a lot of times when we're talking about the interest rate and the amount of interest that they're paying over that time. Talk to your tax advisor, learn how to use the cost segregation, the depreciation, the write-offs for all of that to help offset your income. So the savvy investors that are out there, and this is to your point also about who's buying in this market, who's buying up these properties, it's the people that are skating to where the puck is going to be, is what Wayne Gretzky always said, right? They're people that are forward-looking. Real estate's a solid investment. The interest rates are keeping a lot of people out of the market right now, but the investors that are seeing the opportunities maybe to refinance in another year or two, and the benefits of owning that home are really the ones that are still in the market and being aggressive to try to buy investment properties. And then the other term that investors always want to know is the cap rate, capitalization rate. So that's the basic definition is the rate of return an investor can expect to earn on their investment in a property based on the property's annual net operating income. So when you go through all the net operating income calculation, you take out the expenses, then this example of a $500,000 purchase, the net operating income was about $25,000 per year, so the cap rate is 5%. So just having these terms that you're familiar with, that's always what investors are talking about. They may not know what it means when they're first talking about cap rates, but a typical number where they're going to be comfortable is something in the 4 to 6% range is generally considered a good cap rate for your investment and the security and all of that. The note on the bottom that I put, a higher cap rate may mean it's a more risky property. So that's something that people are looking for, these 10 cap rates that may have something to do with where the property's located, the type of tenants that are there, the ability to collect the rent and all those kinds of things, higher vacancy, all of those types of things that affect it. So, question?
Another comment.
Mhm.
So, how do you know if you have kind of maybe a higher risk property is if it's maybe sold 10 times in the last 10 years?
Yeah. Yeah, so
Places in stock, they're just like.
Yeah, so as realtors, part of your due diligence in helping these investors find the right property, once they understand what their finances are, if they can qualify, what the numbers look like, is getting down to the local experts of what the neighborhood is. This property's been sold 10 times and what the issues are. And again, there's a lot of tenants' rights issues in California, depending on what city and what area you're in, and coming out of COVID and all that stuff. There's some pretty interesting stories about squatters and people not paying rent and all that. So yeah, it's important to know the neighborhoods for sure. That's where you can really help on the real estate side once we get the numbers figured out. But the cap rate is a big indicator of what the quality of that investment is going to be.